Interrupt your regularly scheduled Facebook browsing for it.
There you go. We're good.
We good? Hello, everybody. Tim Arrowood here, People's Home Equity. So we're going to talk a little bit about investment financing for investment properties. So this is a practice session in anticipation of Wednesday night with the man Tim Stout and Casa Hayden. That's right. So generally speaking, investment properties are, well, in the hierarchy of price and ease of buying, it starts with primary residence. You're going to get the best rates. You're going to get the lowest down payment. You're going to get, generally, if easy is a word in mortgages, it's going to be the easiest product to do. Then for the longest time, a second home was a great option for folks. Now, a second home is basically a home that's more than 100 miles from where you live. Right? So I could live in Kingsport and have maybe a second home in Hampton, but not have a house in Johnson City and then a second home in Kingsport. Right? So that's generally it's 100 miles, but it just needs to make sense. For the longest time, a lot of people moving in from out of state, I would say, well, let's do a second home, 10% down, because many times their income isn't portable. Like a lot of people move into town, right? So, well, I'm going to move to town, I'm going to get a job, and I'm going to buy a house. It's hard for that to work that way if your income's not portable. So if you're a computer programmer or customer service and you work from home, we don't care where you work. Or if you're a retiree where you're getting Social Security, it just hits your bank account, right? We don't care. So that income would be portable, and you can buy a primary residence here. But if you own, hypothetically, if I had a customer that was a tree trimmer in Hawaii that wants to buy, this is actually somebody that I'm working with, self-employed borrower in Hawaii that wants to buy a primary residence in Tennessee, it's hard to convince the underwriter that yes, you can run a tree trimming business from Eastern Tennessee in Hawaii. Right? And that shouldn't be a problem, should it? So it's really difficult in those cases. So second homes have been great. The pricing has been great. You only need to put 10% down. The challenge is about a month ago, the Fannie Mae and Freddie Mac, they said, I don't think we should be subsidizing people buying second homes, right? Because those are rich people that don't need that help. So the rates have taken a significant hit. So we've gone from rates for a second home being very, very similar to a primary residence to being about a point more, right? So if it was 3.5, now it's 4.5. It was 4, it's 5. So it was a big change. And so I've got somebody right now that's in the middle of that where I pre-qualified them at the end of December. They got under contract last week. I'm like, I quoted them because of their scores and things. I quoted them a 4 before, and now they're to 5. So, but those are, that's kind of the hierarchy of things. Then we come to investment properties. So investment properties, the Fannie Mae, Freddie Mac products that we generally have, the non-local bank products, these are generally going to require 20 to 25% down, and they can be, they're not especially hard, but the rates aren't necessarily the greatest, right? They're going to be, right now we're probably in, again, depending on credit scores, low to high 4s on investment property with 25% down. 20% down is even more expensive. So, but what we run into is that, and I'm sure you've had other people talk to you about investment properties, but there's some great products like I think maybe Joey has used one, or maybe you guys are talking about, some good local banks, but one of the things that I've seen is that a local bank, they'll make it. They have some good products, maybe as little as 15% down, I think. But generally it's a 20-year term. I'm buying I'm in the process of renovating a commercial property right now. It's a 20-year term. It's a great interest rate, but it's 15-year fixed and then 5-year adjustable. It's 20 years. My payment is a little higher than maybe I want it to be, but at my age, I really need to have the thing paid off anyway. So I'm okay with that. It's a good fit for me. And in my case, it's a it's a renovation loan as well. So I borrowed more than I needed to be able to do the renovation. So it works out well for me. But what I'm running into is that, there are times when people have the cash, but we can't prove the income. So, or in a situation that Matt and I've talked about where maybe you've got so many properties that the banks start to get a little skittish because they see you're extended. Like maybe you've got 10 properties, right? Or maybe you've leveraged this, you've leveraged that. So, or a lot of more sophisticated investors, they have complicated taxes, complicated income statements, things like that. So the product that I'm talking about is very unique in that I don't care if you have any income at all, right? So you just need to have a primary residence that you own. So you're not tricking me by buying putting 20% down and calling it an investment property, but it's really your primary residence. But if you own your own home and you want to buy investment property, all we care about is that you've got a good credit score. We don't even care about your debt to income ratio. We just care that the property is going to cash flow. So what we're going to do is we're going to say we got your credit report. Generally 700 or higher is where you want to be. But according to the things they've given me, we can go down to 600. I don't want to know don't want to know what the rates are for 600. No income. But generally speaking, I'm doing one right now, my first, and it's a couple want to buy, or they're under contract to buy a $160,000 property. They live in New York State. They want to buy a bunch of properties. They really don't want to go through the trouble of documenting everybody's income. They just want to put 20% down, have a 30-year fixed mortgage, and not have to fool with all of the income stuff. So this particular product will allow you to do that. We're looking at, so what we'll do is we'll qualify them as much as you really need to by looking at their credit scores. We're going to be looking at, confirming that they do indeed own a property. And then it's all up to the appraiser. So we order an appraisal that has a rent schedule with it. So if the rent schedule says that it should rent for $1,500 a month and your payment is $1,500 a month or less, we do the deal. We don't care if you've got other properties. We don't care if you have 100 other properties. All we care about is it'll cash flow. So that seemed too good to be true when I started looking into it. So I was thinking, well, maybe the rate's really high. Well, I compared a traditional investment property that I would do. It would be a Fannie Freddie product, and the rates were right where the other ones were. So basically in the high fours. Depends on your score, depends on different things. So probably going to pay a couple of points to get those, but I'm doing an investment property for a past client in Florida right now, and he's paying 2 points to get that rate. When we talk about rate sheet, I can't offer him a high enough rate to where he doesn't have to pay 2 points. So, and that seems to be for that type of thing right where appropriate. So frankly, I don't know, short of some of the local bank products, I don't know. I know I paid at least a point, maybe closer to 2 points for mine, but it seems to be pretty common. So I'm thinking, well, there's something, this seems too easy. So, and I started to ask my rep for this particular, for this particular product. So why do people use this? Well, and they described a situation where you got a sophisticated investor that's already used up as much as they can with the local banks and things like that, and the property will cash flow. So I'm like, okay, now we don't make this program is kind of like a down payment assistance program. We generally don't make as much on this product as we do with a traditional. Like if we're doing a THDA, we have a discounted amount. It's kind of like you guys. Do I want to do an $80,000 purchase price? Well, we just take whatever comes in. We're thankful for it all. But this is a niche of something that we haven't had before, and we're just kind of figuring it out. But it seems really straightforward. So if you know anybody that's interested in looking into that, and the people I talked to on the phone, I said, the key thing for them was they wanted a 30-year fixed so that it would cash flow better. There's also a 40-year loan program, which is really weird, okay? And it's the first 10 years are interest only. So now this $170,000 purchase price, if they did interest only for the first 10 years and then it flips to a 30-year fixed amortized loan, it's only saving them, it's saving them about $200 a month because they're just paying interest for those first 10 years. I don't know the why you would want to do that. I mean, you're thinking short term. Maybe you're playing the game where the property is going to appreciate. I just want to get as much cash flow as I can. I think that people that have different investing philosophies. So it may be that I don't really ever want to pay it down. I just want cash flow. I don't really know what the thought is there. So those are all the positives. The negatives is that there's a 3-year prepayment penalty. All the other products that we do, FHA, VA, conventional, there's never a prepayment penalty. You could close on the loan, pay it off in 2 weeks. Right now, it hurts me and the branch, but there is no prepayment penalty. With this, there is a prepayment penalty for 3 years. Now, the good thing is I saw the loan estimate that went out because we were brokering this product, so it's not internally within People's Home Equity. But the prepayment penalty, it showed on the loan estimate, which is good. It helps me understand, how scary is this prepayment penalty. On this, it could be as much as I think $2,300. So again, my philosophy with these particular borrowers were because it's relatively new to me, I wanted them to have full disclosure. So, so if somebody comes by, 2 months after they've closed on this and they said, we'll give you $50,000 more than you paid for it because we want to buy the house, and they're like, well, that's some quick money. Well, is it worth it? At least that it's, the prepayment penalty is $2,300. That's a bet I'm willing to take, right? And it does diminish over time. So it may be that, if you're 2 years and 6 months in, then your prepayment penalty is going to be less. But that's at this point the only negative that I've been able to see. So I don't know. We can also do it in an LLC's name, right? So you can do it now. Whoever's in the LLC needs to be on the loan. So it's just a pass through there. Let's see. We can do a cash out or a rate term refinance. There's no limit on the number of properties. Up to $1.5 million in loan amount, a minimum of $75,000 in loan amount. 80% LTV. If you've got a great credit score, then 20% down is fine. The lower your credit score, you may require 25 or even 30% down if you've got a lower credit score. No personal income. We don't want to see it. That was the weirdest thing when I'm talking to the rep. Like, nope, don't want to know what they make. Don't want any pay stubs. Don't want anything. Okay, cool. And let's see. So that's pretty much it. Any questions about? Sure, you got it. Make something of that. Pay attention.
Is
My eyes
it
are up here.
$1.5 million in total or per purchase?
Per purchase. So you could do now. It needs to be a 1 to 4 unit. So you can't have
more than 4 doors.
Yeah, no more than 4 doors at
and
once.
under. You just can't go over 1.5.
That's right. And I think that we don't care how many other properties you have with other people, but I think we can do a maximum of 5 properties in this program. So you could have 20 and then we can do 5, or you can do, that kind of thing. So
what's the stipulation within that? Is it like, hey, look, 5 is the number, or is there a certain amount of debt that's carried that is the limit?
just the number.
Okay.
Yeah.
Did you have a question, Joe?
He just answered it.
Oh,
Oh,
okay.
yeah.
What's the minimum credit score again? I know you said good credit score.
620.
It says 600. Now, I would think that it's going to be terrible. I mean, you may have to put 50% down in order to get
Yeah.
but it's like, okay, back to the Wild West a little bit here. So, and one of the other things is that if you have We're looking at the debt service ratio, so we need to have, let's see, if you're doing 20% down, we need to have a debt service ratio of 1. So if your payment's $1,500 a month, then you need to be able to rent it for $1,500 a month. If you put 25% down and have above a 700 credit score, we don't care what the debt service ratio is at all. Right? So your payment could be $1,500 a month, and it'll only the appraiser could say, well, it's only going to rent for $1,000. You're taking that extra risk by having the higher credit score and putting more money down. It's like, okay, if you want to do it, we're not going to hold you back. I'm not saying you should. I'm saying, and my thought is that, okay, well, you're going to buy it and perhaps you're going to renovate it a little bit, kick the renters out, or renovate, and you should be able to get more out of it. You have intentions of doing things. Now, it still has to appraise. It still has to be in living condition. So that's one of the things that I think that I have not gotten to that point in their process yet, but it still has to be safe and sound and sanitary. It doesn't have to be pretty. It just needs to be in a spot where there's not holes in the walls. They're not, you're still looking for, it needs to be structurally sound, and toilets that flush and those kind of things. But it's not an FHA loan, so it's going to be a little bit more forgiving than the others. So it's and I've thought about this for some of the folks that have a lot of money that are moving here. Maybe if they've got enough money, instead of a second home, I might be able to use this to say, well, you got 20% down, you own a home, and you don't have a job here, and it may or may not make sense to do a second home, or it may be better to look at just buying property here. Now, it starts out as an investment property, and if you want to, if you plan to move here later, that's your prerogative. So it doesn't have to always stay an investment property. So, but it's the rate is again the thing that I feel like is going to be the advantage is that less paperwork and a longer term that's fixed. So 4.75 right now feels really heavy, but who knows what's going to happen in the next 30 years. And to be sitting on a 30-year fixed is pretty cool.
Yeah. So it could be a single-family investment property, duplex, triplex, quadplex. What about like a plot of land with multiple single-family on it type of thing? Still in the same?
I don't know.
Okay.
The answer is I don't know. I need to find out an answer to that, because that could be that's basically what you had, right? What you bought was kind of a mishmash of several different.
It's a single family house, and a garage apartment, and a single wide trailer.
Okay.
That's what I'm gonna ask too.
I was gonna ask,
does it frown upon the single wides? Because those sometimes are stuck on like hey, we have these two great houses.
Would you make a note of that to ask about what if multiple properties on one site, and also what they think about single wides and double wides and manufactured homes? So I don't know. That's a good question. If you found a place that had, I don't know how that would work.
Yeah, I just went.
Piece of land with 4 single wides on it. Can I buy that?
Well, I saw one. It was a house, and then they had it was on one plot. And you had the house, and behind it was 3 trailers. They were single wides. They all had their own electricity, their own water,
their own meter and everything. Okay.
Yeah. So it was a good cash flowing.
Yeah.
It was a bit rough, but it's stuff that I was like, traditional financing would be a bit tricky here.
Yeah. So I'll find out. So I honestly, so that'll be good. I'm glad practicing with you all day. So tomorrow night I'll have it as soon as
I have a question.
So I don't know. Anything else? Any other questions? Going once? Going twice?
I heard that the Fed's going to raise interest rates a few times this year. When do you think the first bump will be? We've already
seen the first bump. What's odd is that I'm in the business and I read the news. I'm like, where are these people living? I don't. The correlation isn't as obvious as they present it. Is what I'll say, because I see advertising. Some people, hey, rates have improved. I'm like, what are you talking about? I just got, what happens in my world is that usually, by 10 or 10:30, I get a notification that the rates for today are available, right? The pricing for rates for today are available. And for, most of my career, it's been, there's times when it's different, but usually the pricing comes out 10 or 10:30, and it stays stable for the entire day. Right? So I know that through the rest of the day, everything's going to be fine. For the last month, it's been, oh, we have a price worsening today. Oh, there's 2 in the afternoon. Right? So now it isn't like it's moving a point. It's moving slightly, but there's changes, and it's like we'll take, it's worsening, it's worsening, it's worsening. Oh, it got better. It's worsening, it's worsening, it's worsening, it's better. I'm going the opposite direction because I'm worsening, meaning the rates are going up, right? And then it gets a little bit better. So, the good news is that we've got our finger directly on the pulse of what the rates really are. Many times a bank will say, their rates are this, and the good thing is that they appear to be stable. What they're doing is they've built in fat in those, and they're not just changing as often as we do. So it works for us and against us because we could say, I could if I didn't lock you in the morning, I've missed that opportunity, and so the pricing is going to be better or worse in the afternoon, which is really weird, right? But the answer is the trend is upward. My crystal ball's broken.
What about those folks that say, I want to buy in the spring, but I want to get pre-approved now? Can I lock my rate in now without having a property?
I do not have a product that does that, so I've got to have a property to the lock too. So there was a company. They talked about having that available to us like last year, but the pricing was so bad. And but really, what's happening is we're having to hedge our bets because the market determines what the rates are. Right? So anything else is a gimmick. So, and actually locking the rate is unique, is because we lock it, and then what we've done when we lock it is we buy insurance against whether to hedge that bet. So I'm not privy to all the details, but that's what I've been told. So if rates improve, then we might get a little better at the end because it's when we securitize it on the secondary market, it's going to be the day that we close when it's ready to package up. So if rates are worse on that day, then we're going to exercise our option on the insurance. And if it's better, then what we'll do is we'll maybe get that advantage. So it's there are instruments put into place to make it to where there's some stability to the market. So more than you really care to know about. But hey guys, this boring guy keeps talking. I'm sorry. The song and dance starts later. It'll be fun. Trust me. So, I don't know. Is that helpful?
Yeah.
Okay. So, anything else? Oh, I've got some flyers. You guys can, flowers. I got some flyers. So I can't move because I'm tethered here, but
Yeah, you're stationary.
I got some. Hey boys, you want to hand some things out? You guys could be a big help to me. Just don't trip over the cord.
Can you show one of them to the
Oh, yeah.
camera?
Happy helpers. Come on. Come on.
There we go. I just see that.
Yeah.
Cross gates. One here.
So if you got any questions about it, let me know. It's odd, I can pre-qualify somebody for this product, but the weird thing is it depends so much on the property that it's different. Because it's like, well, I mean, the borrower part's easy. It's the property that we have to qualify. So it really depends. So, anyway, let me hold that.
Yeah.
All right. All right. Ding-a-ling-ling, ding-a-ling-ling. Ding-a-ling. Oh, and I brought some other of these. If you guys don't have, any or any of the most recent ones. So if you need a cheat sheet, and then on the back on this new one, it's got some QR codes for things like, our guarantee. There's a whole website for that, and different things, some links on there if you need anything. So I don't know if if everybody has seen one of those or has one of those, so I brought extra. So that's all I got.
Thank you, sir.
Thank you.